Welcome to the deep dive. Today we're tackling something that's, well, it's really shaking things up in finance and sparking some pretty intense debate. The title we're working from is pretty provocative. Stablecoins, innovation, control, or the mark of the beast?
Yeah, that definitely grabs your attention.
It does. Now, for anyone following crypto, the price swings can be absolutely wild, just dizzying.
That's the standard, yeah.
But stablecoins, they promise something different, right? Like the calm in that storm. A digital dollar that supposedly stays stable.
Supposedly is the key word there.
Exactly. But how stable are they really? And, what's the hidden cost? What are we not seeing?
Right.
At their core, stablecoins they're a fascinating idea in digital currency. Completely different from Bitcoin or Ethereum in terms of volatility, or at least that's the goal.
Right. The design philosophy is stability first.
They're meant to keep a consistent value,
Yeah.
usually by being pegged, tied to a real-world asset, most often the U.S. dollar. So like a digital anchor in the crypto sea.
That's the concept. And that's precisely what we're here to explore today. Our mission in this deep dive, it isn't just about the tech, the finance jargon.
Well,
It's really about peeling back those layers of trust, control, and looking squarely at what these digital assets might actually mean for the future of how we buy and sell things.
yeah, the future of commerce itself.
Exactly. We're going to dig into the material we've gathered, pull out the most important insights, and really help you understand the kind of profound implications here. We want to move beyond just the headlines.
Get past the hype of the fear.
Right, to really grasp why this matters. For your finances maybe, but also for society more broadly.
Yeah.
What are the actual benefits? What are the real dangers? And, what questions should you be asking yourself about this whole evolving landscape?
The foundations of stability, understanding stablecoins.
Okay, so we've all heard about Bitcoin's crazy price swings, right? Up 10%, down 20%. But what about these stable coins? Let's really unpack that. What exactly makes them stable or tries to in this super volatile crypto world?
That's the fundamental question, isn't it? At its core, a stablecoin is a type of cryptocurrency, but it's specifically engineered to minimize that price volatility you just mentioned.
Engineered how?
Well, primarily, it achieves this by pegging its market value to some other more stable asset. Now, theoretically, that could be anything gold, maybe, or a basket of currencies, even real estate, I suppose.
But in reality,
The vast majority, almost all of them, are pegged one-to-one to fiat currencies. Think the U.S. dollars, the euro, maybe the yen. The idea is simple. One stablecoin, let's say one USDT or one USDC, should always be redeemable for exactly one U.S. dollar.
okay, so it's backed by something real. How do they maintain that peg? Magic.
Not quite magic. Usually involves holding reserve assets. So the company issuing the stablecoin, they'll hold actual U.S. dollars or maybe U.S. Treasury bonds or other really liquid, low-risk assets in, say, a bank account. And the amount they hold is supposed to match the number of stablecoins they've put into circulation.
That's the collateralization you hear about.
Exactly. That collateral is what's supposed to give users confidence that their digital dollar actually has real-world value behind it. It's not just code. There's something tangible backing it up.
Got it. So while Bitcoin might be about, decentralization or a new economy.
Right, different goals entirely. Stablecoins are laser-focused on solving one specific problem. The need for a digital way to pay or hold value that doesn't swing wildly. It needs to be consistent, predictable. Like a digital dollar you can send anywhere, anytime, without that anxiety of, will it be worth 20% less when it arrives?
So the promise is basically our everyday money but digital, running on blockchain rails. What does that actually unlock?
Precisely. And the promise is, well, it's potentially huge. Think of stablecoins as a crucial bridge. They connect the old world, traditional finance, with this new burgeoning world of crypto.
A bridge, okay. What can cross that bridge?
Imagine sending money internationally, not in days like a bank wire, but almost instantly, with incredibly low fees, without needing multiple banks in the middle, and crucially, without the value changing mid-transfer.
That sounds potentially revolutionary for a lot of people.
It really could be. For businesses, maybe it's faster supply chain payments globally.
No.
For individuals, it could mean sending money home to family overseas instantly, skipping those painful bank fees and waiting periods.
Right, remittances are a huge market.
Absolutely. They facilitate these borderless payments, making global transactions faster, cheaper, more accessible, often 24/7, not tied to banking hours or holidays. They also play a vital role within the crypto world itself.
How so?
Well, traders use them constantly. If Bitcoin looks like it's about to drop, they can quickly sell their Bitcoin for, say, USDC, a stablecoin. They haven't left the crypto ecosystem entirely. They haven't cashed out to traditional dollars yet, but they've moved into a stable asset to ride out the storm.
A safe harbor.
Exactly. A digital safe harbor in those often turbulent crypto seas. And this opens up all sorts of possibilities. Things like microtransactions paying tiny amounts, fractions of a cent for online content, which is hard now because of fees, or fueling decentralized finance, DeFi, where these stable digital assets are used for lending, borrowing, earning yield, all on the blockchain.
Okay, this is where it gets, frankly, a bit mind-boggling. Just how big is this stablecoin thing already? Because it feels like it's moved beyond just a niche experiment.
Oh, absolutely. We're not talking small potatoes here. We are talking massive, almost staggering amounts of digital money circulating. Our sources really highlight two giants dominating this space.
Who are they?
First, there's Tether. You'll see it as USDT, US dollar Tether. Its market capitalization is hovering around, get this, $160 billion.
Wow. Okay, $160 billion.
And the other one?
That's USDC, USD coin, also pegged to the US dollar. Its market cap is roughly $64 billion. Still huge.
So, just doing some quick math here. $160 billion plus $64 billion. That's over $220 billion just between those two. What does that represent in terms of the whole market?
That's the kicker. Together, Tether and USDC alone represent well over 90% of the entire stablecoin market.
90%.
It's not just big, it's utterly dominant. It's basically a duopoly controlling this critical piece of the crypto infrastructure. And that kind of concentration, well, it signifies real power and influence.
What are the implications of that level of concentration?
The implications are significant, and frankly, they raise some serious questions about systemic risk. This scale tells us stablecoins, especially these two big ones, aren't just fringe financial toys anymore.
Right.
They're integral cogs in a rapidly evolving global financial machine. Their sheer size means they could potentially impact global finance in ways we're honestly just starting to wrap our heads around.
Like what? What's the worry?
Well, imagine a crisis, a run-on-the-bank scenario, but for Tether or USDC. If everyone suddenly tried to redeem their stablecoins for real dollars all at once, and the issuer couldn't meet demand, the fallout could be immense.
It wouldn't just affect crypto traders.
Potentially not. It could ripple outwards. It could impact traditional financial institutions that might be holding some of these stablecoin reserves, or even touch the broader economy if these coins become more deeply embedded in everyday payments, which is part of the goal, right?
Yeah.
And this ties into a crucial point. Our source material summarizes neatly. Pegged to fiat, stablecoins boast scale, but lack central bank guarantees. This is a critical distinction. Everyone needs to understand this.
Lack central bank guarantees. What does that mean in practice? Compared to, say, the dollars in my regular bank account.
It means that unlike your regular bank deposit, which in the U.S. is typically insured by the FDIC up to a certain limit and backed ultimately by the Federal Reserve and the government, stablecoins don't have that safety net.
So no government bailout if things go wrong?
Essentially, no. There's no FDIC insurance for your stablecoin holdings.
Yeah.
There's no central bank acting as a lender of last resort, ready to step in and provide liquidity if the issuer gets into trouble. Even with these massive market caps, this lack of sovereign backing introduces a whole different set of risks.
So when I hold USDC, I'm not trusting the U.S. government. I'm trusting who? The company that issues it.
Exactly. You're trusting Circle, in the case of the USDC, or Tether Limited for USDT. You're trusting a private company's balance sheet, their operational integrity, their transparency about reserves.
Doesn't that fundamentally change the nature of trust in money, shifting it from a government to a corporation?
It absolutely does. It forces us to ask different questions. Are the reserves really dollar for dollar? Are those reserves truly liquid and safe? What happens if the company faces legal issues or mismanagement or goes bankrupt? The security blanket you feel with traditional bank deposits, woven from layers of regulation and government backing, just isn't there in the same way for stablecoins yet. It's a trust in private actors managing vast sums of money, rather than trust in the full faith and credit of a nation.
The regulatory scrutiny, the Genius Act.
Okay, so given this scale, hundreds of billions of dollars, 90% market concentration, questions about reserves and trust, it's not really surprising that regulators are starting to pay very close attention, right?
It's surprising at all. Inevitable, really.
And our sources point to a pretty significant move by the U.S. Congress. Back in July, they apparently declared something called Crypto Week. Sounds catchy.
Yeah, a bit of branding there.
And out of that came the Genius Act. Now, the name itself, the acronym, is probably complicated, but the takeaway seems to be, this is a serious push to bring stablecoins under federal oversight, This wasn't just tinkering, it feels like a major statement.
It absolutely was. This signals a real shift. The motivation behind the Genius Act is complex, but it's deeply rooted in these growing concerns about financial stability and, importantly, consumer protection.
Why now, though? Why the sudden urgency from Congress?
Well, a few things. The sheer size we just talked about is one factor. As stablecoins grow and get more intertwined with traditional finance, the potential for systemic risk increases. A big stablecoin failure could, theoretically, spill over and cause wider financial problems. Think contagion.
Like a domino effect.
Potentially, yes. And beyond that, there's a strong drive to protect consumers. We've seen too many instances in the broader crypto space where people lost huge amounts of money due to collapses, hacks, or fraud. Regulators feel a responsibility to put some guardrails in place.
So it's moving from a wait-and-see approach to something more active.
Exactly. The Genius Act marks a significant shift away from a relatively hands-off stance. It's Congress saying, okay, these things are potentially systemically important or could become so. We need a framework. It's an attempt to integrate these novel instruments into the existing financial regulatory structure, partly to mitigate threats, but also arguably to legitimize the space and build broader confidence, but on the government's terms.
And our sources mention that one very specific, very public event was a major catalyst for this regulatory push, the collapse of Terra Luna. We touched on it briefly, but it seems like that was a real wake-up call. Can you give us the slightly less technical version of what happened there and why it scared regulators so much?
Absolutely. Terra Luna, back in May 2022, was a watershed moment. It starkly highlighted the hidden vulnerabilities in some stablecoin designs. See, most stablecoins we've discussed, like USDT and USDC, claim to be collateralized backed by real assets.
Right, the dollars and T-bills.
Correct. But Terra USD, or UST, was different. It was an algorithmic stablecoin.
Algorithmic, meaning no real reserves.
Essentially, yes. Its peg to the dollar wasn't maintained by holding actual dollars, but by a complex software algorithm linked to a sister cryptocurrency called Luna. The idea was, if UST's price dipped below $1, arbitrageurs could burn UST to mint Luna, reducing UST supply and pushing the price back up. If it went above $1, they'd burn Luna to mint UST, a sort of automated balancing act.
Sounds clever, but maybe fragile.
Extremely fragile, as it turned out. The whole system relied on continuous demand and, critically, trust in Luna maintaining its value. When the market got shaky and a large amount of UST was suddenly sold off, the algorithm couldn't keep up. It triggered what's called a death spiral.
Death spiral, that sounds bad.
It was catastrophic. As UST lost its peg, people panicked. More UST was burned to mint Luna, flooding the market with Luna, which crashed Luna's price. A worthless Luna meant even less confidence in UST's backing, causing more selling of UST. You see the cycle.
A complete meltdown.
Billions of dollars evaporated in days. It was a brutal lesson that not all stablecoins are the same, and algorithmic designs without solid, tangible collateral can be incredibly unstable. It hammered home the absolute need for transparency and high-quality reserves.
So how does the Genius Act try to prevent another Terra Luna disaster? What specifically does it do regarding those reserves?
It tackles that head-on. This is maybe the most critical part of the act, based on our sources. It sets very strict rules about what can actually back a stablecoin. Specifically, it recognizes only cash and short-term U.S. Treasuries as reserve assets.
Only those two. Why so specific?
Because cash and short-term T-bills are considered the gold standard for safety and liquidity in the financial world. Cash is, well, cash. Instantly usable. Short-term U.S. Treasuries are debt issued by the U.S. government, backed by its full faith and credit. They're seen as virtually risk-free, highly stable in value, and easily sellable if the issuer needs cash quickly to meet redemptions.
So no more weird algorithms or potentially risky corporate bonds in the reserves.
That's the intention. By restricting reserves to these ultra-safe, highly liquid assets, the Act aims to provide much greater transparency and actual stability. It gives investors more confidence that the digital coin they hold is truly backed, one-to-one, by something solid and readily available. The goal is to rebuild trust after failures like Terra Luna and make stablecoins less vulnerable to runs. It's about ensuring the stable part isn't just a marketing claim.
Makes sense. But it feels like there's this inherent tension here, doesn't it? Our source material puts it nicely. Innovation strides ahead, yet stability safeguards remain incomplete. It's like we're building this incredibly fast car, but we're still figuring out the best brakes.
That's a perfect analogy. It really captures the core dilemma. There's this ongoing debate, this push and pull, that defines the whole stablecoin conversation right now.
What's the debate exactly? Regulation good or bad?
It's more nuanced than that. On one side, you have proponents arguing that strong regulation, like the Genius Act aims for, is absolutely necessary. It protects consumers, it prevents the kind of systemic shocks we worried about, and ultimately, it builds the trust needed for stablecoins to be widely adopted in the mainstream. You need rules for people to feel safe.
Like we have for banks.
Exactly, heavily regulated for a reason. But then there's the other side of the coin. Could rules that are too strict, too prescriptive, actually stifle the very innovation that makes stablecoins exciting in the first place?
How so?
Well, the crypto world thrives on things like decentralization, permissionless building, rapid experimentation. If regulations become too rigid, say, by only allowing cash and treasuries as reserves, it might slow down development, push innovative companies to operate in countries with looser rules, or even prevent potentially beneficial new types of stablecoins from emerging. What if someone wants to create a stablecoin backed by something else, like sustainable assets, for a specific purpose? These rules might make that impossible.
So regulators have a tough job.
Incredibly tough. They're walking this tightrope. How do you encourage innovation that could bring real benefits, faster payments, financial inclusion, while also ensuring the system is safe, protecting people from scams and collapses, and managing those big picture financial stability risks?
What are the trade-offs?
The trade-offs are complex. Too much regulation, and you might kill the golden goose, losing the potential benefits. Too little regulation, and you risk chaos, repeated crises, and potentially significant harm to individuals and the economy, which could discredit the whole idea. Finding that sweet spot, those stability safeguards that work without crushing innovation, is the billion-dollar question right now, and the answer is still very much being written.
The technical promises and persistent perils.
Okay, let's shift focus a bit from regulation to the actual technology. What makes these stablecoins work under the hood? Our source material makes a pretty bold claim. Faster, cheaper digital payments are proven. That sounds great, but how real is it?
It's quite real, actually. This isn't just theory. We see it in practice. The technical foundations of stablecoins running on blockchain networks do enable significant efficiencies compared to traditional systems.
Give me an example, something relatable.
Okay, think about sending money overseas to family, international remittances. Using traditional banks, it can take several days, involve complicated forms, and the fees. Oh, the fees can be really high, right? Banks take a cut, currency exchange takes a cut.
Yeah, I've heard stories. It can eat up a big chunk of the money sent.
Exactly. Now imagine using a stablecoin. Because it runs on a blockchain, the transfer can happen directly between sender and receiver, often in minutes, sometimes seconds, depending on the network. And the fees are typically much, much lower because you're cutting out many of those intermediary banks and processors.
Okay, that's a tangible benefit. What about other things like small payments?
That's another huge area. Microtransactions. Think about paying like 5 cents to read one online article, or a penny per minute to stream music, or even tiny payments between smart devices in the Internet of Things. Right now, that's often impossible because the minimum fee for a credit card transaction or bank transfer would be way more than the payment itself.
Right, the fee would dwarf the actual cost.
Precisely. Stablecoins, with their low transaction fees, could make these kinds of micropayments economically viable, potentially unlocking whole new business models online.
So how does the tech actually enable this? What's the secret sauce?
Well, a couple things. First, these blockchains are designed as decentralized ledgers. Transactions are recorded transparently, immutably, and often very quickly across a network of computers.
Yeah.
You're not waiting for a central bank's business hours or for multiple banks to reconcile their books. The confirmation happens on the network itself.
Faster settlement.
Much faster. Second, and this is key for cost, is what we call disintermediation.
Cutting out the middlemen.
Exactly. Yeah. Traditional finance involves a whole chain of intermediaries. Your bank, the recipient's bank, correspondent banks, clearinghouses, maybe currency exchange platforms, and each one might add a fee or take a slice. Blockchains allow for more direct peer-to-peer transfers, drastically reducing the number of intermediaries needed and therefore the associated costs.
So speed from the network, cost savings from cutting out intermediaries.
That's the core of it. And the potential impact, especially globally, is profound. It's not just about convenience for people already well-served by banks. It's about democratizing access.
How so?
Think about the billions of people worldwide who are unbanked or underbanked. They don't have easy access to traditional financial services. Stablecoins, potentially accessible through just a smartphone, could offer them a way to send and receive money cheaply, participate in the global digital economy, maybe even protect their savings from high local inflation by holding a dollar-pegged asset. It shifts power away from centralized gatekeepers towards a more distributed, accessible system. The key insight isn't just speed or cost, it's inclusion.
That's a powerful vision. Speed, cost, access. But there's always a but, isn't there? Our sources also flag persistent risks. Encryption vulnerabilities and counterparty risks. These sound technical and maybe a bit worrying. What do they mean for the average person thinking about using stablecoins?
They're definitely critical concerns, and yeah, they can sound intimidating. Let's break them down. Encryption vulnerabilities, think of this as the digital security aspect.
Like getting hacked.
Essentially, yes. Stablecoins rely heavily on cryptography, complex math to secure everything. Transactions, ownership, wallets. If there are flaws in that underlying crypto code, or bugs in the smart contracts that run the stablecoin on the blockchain, hackers could potentially exploit them to steal funds or disrupt the system.
So the tech itself could be flawed.
It could be. Or maybe the tech is fine, but your security gets compromised. If you lose your private keys, the digital password to your crypto wallet, through phishing scams, malware on your computer, or just carelessness, someone else can access and steal your stablecoins. So even if the coin holds its value perfectly, your specific coins aren't safe if your personal digital security is weak. It's like having cash in a wallet with a hole in it.
Okay, so encryption risk is about the tech and personal security. What about counterparty risk? That sounds different.
It is different, and it goes right back to that core idea of backing and trust, especially for collateralized stablecoins like USDT and USDC. Remember how they're supposed to hold real dollars or treasuries in reserve?
Yeah, one-to-one backing.
Right. The counterparty is the company, the entity, that is actually holding those reserves. Circle for USDC, Tether Limited for USDT. Counterparty risk is the risk that that entity fails to meet its obligations.
Fails how?
Several ways. What if the company goes bankrupt? What if it turns out they didn't actually hold enough reserves, or they held riskier assets than they claimed to boost their own profits? What if their assets get frozen by regulators for some reason? If any of that happens.
The stablecoin might not be redeemable for $1 anymore.
Exactly. The peg could break. The stablecoin could suddenly become worth less than $1, maybe significantly less, because the backing isn't fully there or accessible. This risk highlights that even with a 1.1 peg claim, your stability and security are not guaranteed unless you have absolute trust and transparency from that counterparty, that issuer. You're trusting their financial health and integrity. It's a shift from trusting a government system to trusting a corporate one, and that comes with its own baggage. Your coin is only as stable as the company behind it.
Echoes of history and global experiments in control.
You know, it's fascinating how often looking back at history gives us insights into these cutting-edge technologies. Our sources bring up a really interesting, maybe even slightly chilling parallel. Ancient Rome and its problems with coinage debasement. Sounds academic, but the connection feels surprisingly relevant.
It's incredibly relevant. The Roman example is a classic, powerful lesson about the absolute centrality of trust in any form of money, and what happens when that trust erodes.
So what exactly was coinage debasement? What did the Romans do?
Okay, so over centuries, especially when the empire was under financial stress funding wars, massive building projects dealing with corruption, emperors would start to mess with the coins. They'd reduce the amount of precious metal like silver or gold in each coin.
How? Like melting them down and adding cheap stuff?
Pretty much. They'd mix in more base metals like copper or bronze, or sometimes physically shave bits off the edges. They did this to stretch their limited supply of gold and silver, essentially creating more money out of thin air to pay soldiers or cover expenses.
Did people notice?
Initially, maybe not significantly, or they went along with it. But as the debasement got worse, coins that were once nearly pure silver becoming only 50%, then 20%, then even less people absolutely noticed. They realized the coins they were receiving were intrinsically worth far less than they used to be.
And the consequence?
Devastating, a complete breakdown of public trust in the currency. This fueled runaway inflation as merchants demanded more and more of these debased coins for their goods. Eventually, it severely hampered trade, because why would you accept coins you knew were practically worthless in exchange for valuable grain or pottery? Our source puts it bluntly: without metal backing, trust evaporates.
Wow. Okay, the parallel to stablecoins seems pretty direct then, doesn't it?
Incredibly direct. Just like the value of Roman coins ultimately depended on the trust in their precious metal content, the value of a stablecoin hinges entirely on the trust in the quality and the verifiability of its reserves, whether it's cash, T-bills, or something else.
So if people start doubting the reserves,
If the public loses faith that the issuer can actually redeem each coin for $1, maybe because of rumors, lack of transparency, or a regulatory crackdown, that trust can evaporate just as quickly as it did for Roman denarii. The peg breaks, confidence collapses, and the stablecoin fails. It doesn't matter if it's backed by metal or digital entries linked to bank accounts. The core issue is trust in the backing. Rome teaches us that perceived trustworthiness isn't just nice to have, it's everything.
A stark lesson. Okay, let's jump from ancient history to a very modern experiment, also cited in our sources, China's digital yuan. What was China trying to achieve with its own central bank digital currency, the ECNY? Was it about efficiency, like the stablecoins we discussed?
Efficiency was part of the narrative, but the primary objective for China's digital yuan seems much clearer. Control. The Chinese government aimed to create a CBDC, a central bank digital currency, that would give it unprecedented visibility and influence over its domestic financial system and economy.
Control in what way?
Think about it. This wasn't just about making payments faster. It was about enhancing the state's ability to monitor money flows, implement monetary policy directly, perhaps bypassing commercial banks, combat illicit activities through enhanced surveillance, and collect vast amounts of transaction data.
So how did it go? Did it work? Did people embrace it?
Well, our source sums it up quite starkly. It excelled in control but failed to win mass adoption.
Failed to win mass adoption. Why?
Let's unpack the control part first. The ECNY allows for incredibly granular, real-time tracking of transactions. The government can potentially see who spends what, where, and when. It opens the door to potential censorship of payments, blocking transactions for specific goods, services, or individuals. It's centrally issued, giving the People's Bank of China direct control. There's even talk of programmable money features in the future, like money that expires if not spent or can only be used for certain things.
Okay, that's definitely control, but why didn't people flock to use it?
Several reasons, likely. First, the privacy implications are pretty stark. Citizens probably understood that using the ECNY meant giving the government a direct window into their financial lives, which understandably leads to reluctance. Second, China already has incredibly popular and convenient digital payment systems, WeChat Pay and Alipay. They're ubiquitous, deeply integrated into daily life.
So the digital yuan didn't offer a compelling reason to switch.
For the average person, probably not. The existing systems work really well. Why switch to a government-run system with potential privacy downsides if the convenience isn't significantly better? It really highlights this fundamental tension. A CBDC might offer the state enhanced oversight and efficiency, but that doesn't automatically translate into benefits or trust for the users, especially if privacy concerns loom large and existing alternatives are good enough.
That's fascinating. It's like a powerful government tool that the public just shrugged at. Which brings us to this core split, our source highlights. Centralized digital currencies secure oversight, while private stablecoins face collateral and trust hurdles. This feels like the two main paths forward for digital money, right? What does this split mean for us, for the future?
It absolutely maps out the two dominant and very different directions digital currency is heading, and they face completely different sets of challenges.
Okay, break down the two paths.
On one path, you have the state-backed CBDCs, like China's digital yuan or potential digital dollars or euros. Their main selling point from a government view is that secured oversight. Direct policy implementation, fighting crime, maybe financial inclusion under the state's watchful eye. But they're big hurdles. Public acceptance, massive privacy concerns, fears of government overreach and surveillance. The key question for individuals there is, how much financial privacy are you willing to trade for potential state-guaranteed stability or efficiency?
And the other path, the private stablecoins.
That's the path of Tether, USDC, and others, issued by private companies. Their appeal is often faster global payments, integration with the existing crypto ecosystem, maybe operating with less direct government minute-by-minute oversight than a CBDC might have. But their hurdles are totally different. They grapple constantly with proving their collateral. Do they really have the reserves? Are they safe? Are they transparent? That's the collateral hurdle.
And the trust hurdle.
That's the big one. Users have to place their trust not in a government, but in a private corporation's promises, its audits, its regulatory standing, its operational security. Will Circle or Tether really always give you $1 back for your coin? That's where the Genius Act tries to step in to shore up that trust through regulation.
So we're really at a crossroads. State-controlled digital money versus privately issued digital money.
Precisely. And the future likely involves some mix of both, competing and coexisting. But the fundamental question is about control. Do we want a future where the state has potentially granular control over digital money, offering stability but perhaps limiting privacy? Or do we prefer private innovation, which might be more agile but carries risks related to corporate trustworthiness and reserve backing? The challenges are mirror images of each other, reflecting this deep debate about who should ultimately manage the flow of value in our increasingly digital world.
The human element: volatility, trust, and mental well-being.
Okay, we've talked tech, regulation, history. But ultimately, this affects real people, and our source material gives us a glimpse of that with Investor A's experience. It really paints a picture of the emotional side of engaging with these new assets. Tell us about Investor A.
Right, this story really brings the abstract risks down to a personal level. Investor A, fearing runaway inflation in their local currency, decides to swap their traditional money for a new stablecoin pegged to the Korean one. The logic seems sound, right? Escape inflation by holding a stable digital equivalent.
Seems like a reasonable move, trying to preserve value. What happened?
The plan backfired, unfortunately. Only to see exchange rates swing wildly when regulatory news hit. Suddenly, the stable asset wasn't stable at all.
Wait, why would regulatory news make a one-peg stablecoin swing wildly? The one itself didn't suddenly become unstable, did it?
No, exactly. The underlying asset, the one, likely remained stable. The volatility came from the stablecoin itself, or rather, the perception of its risk. When news breaks about potential new regulations, maybe a government crackdown, new reserve requirements, or even just uncertainty about the rules, market sentiment can shift instantly.
So people got spooked about the stablecoin, not the one.
Precisely. Investors might suddenly fear that the issuer won't be able to maintain the peg, or that the issuer faces legal trouble, or that holding or trading this specific stablecoin might become difficult or risky. This fear triggers selling pressure. People rush to get out, trying to swap the stablecoin back to fiat or into another asset.
And that selling pressure breaks the peg even temporarily.
It can, yes. A sudden imbalance between supply, people selling, and demand can cause the stablecoin's price to deviate, sometimes significantly, from its intended 1-1 value. It's a crisis of confidence, not in the underlying currency, but in the stablecoin issuer or the regulatory environment it operates in.
Wow. So Investor A swapped out of the fear of slow burn inflation.
And right into the fear of sudden, unexpected market shocks in an asset that was supposed to be their safe haven.
That sounds incredibly stressful. Talk about the psychological impact.
It's huge. Imagine the whiplash. You make a move seeking safety and stability, only to find yourself exposed to a different, maybe even more jarring kind of volatility. It completely undermines your sense of financial control and predictability. It highlights that stability in the digital asset world is incredibly fragile and complex. It's not just about the peg. It's deeply tied to market perception, regulatory winds, and that fundamental, sometimes shaky trust in the issuer and the system. Financial stability isn't just numbers on a screen. It's tied directly to our mental and emotional well-being.
Absolutely. And given these potential emotional swings, this uncertainty, our source offers some really practical mental care advice. It speaks directly to you, the listener, saying, feeling wiped out by these swings, start with a small position, set clear exit points, and pace yourself. Your peace of mind matters more than a perfect trade. That feels like really grounded advice.
It's incredibly important advice, and it connects to something broader. The need for financial literacy and emotional resilience when we navigate these new complex technologies. Especially in markets like crypto and stablecoins, which are still evolving rapidly, a cautious, measured approach isn't just smart, it's essential for your mental health.
Break down that advice. Start with a small position.
It means don't bet the farm. Don't put all your savings into something you're still learning about or that carries inherent risks you don't fully understand. Start small, test the waters, gain experience without risking catastrophic loss if things go wrong.
Set clear exit points.
Have a plan before things get emotional. Decide in advance. At what price point will you cut your losses if the investment goes down? At what point will you take profits if it goes up? Having these predefined points helps you avoid making impulsive decisions driven by fear when prices are crashing or greed when they're soaring. It adds discipline.
And pace yourself.
These markets often run 204/7. It can be all-consuming if you let it. Pacing yourself means recognizing you don't need to watch every tick every minute. Take breaks. Disconnect. Protect your time and energy. Your health matters.
Which leads to that final point. Your peace of mind matters more than a perfect trade.
That's the core insight, isn't it? This whole endeavor, investing, using new financial tools, it shouldn't destroy your mental well-being. The goal isn't just maximizing profit at any cost. It's about navigating these opportunities in a way that's sustainable for you, emotionally and psychologically. Sometimes the perfect trade just isn't worth the stress and anxiety. Prioritizing your peace of mind, understanding your own risk tolerance, setting boundaries, that's crucial self-preservation, especially in volatile and uncertain markets. It's financial advice, sure, but it's really life advice for dealing with modern complexity.
The ultimate question, liberation or ledger of control?
Okay, now we get to the part that sparked that really provocative title, the Doctrine, History, Cultural Analogies section in our source material. It brings up Revelation 13 from the Bible, describing the mark of the beast as something required to buy or sell. And then it asks, point blank, sound familiar when every transaction requires a digital ID? That was quite a leap, but it forces you to think.
It's definitely a powerful, almost visceral analogy. And whether you take it literally or purely as a metaphor, it tapped into a deep-seated anxiety about ultimate control, specifically control over our ability to participate in the economy in daily life.
How does it connect to stablecoins or digital IDs?
Well, imagine a future system, whether it's based on CBDCs or heavily regulated stablecoins or some other integrated digital identity system where every single financial transaction requires verification through that digital ID. Buying groceries, paying rent, getting paid, everything leaves a digital trace tied directly to you.
Sounds efficient, maybe, for tracking things.
Potentially very efficient for governments or large institutions, yes. Think about simplifying tax collection or cracking down on illicit finance. But the flip side is the potential for unprecedented levels of surveillance and control. If participation in the economy is gated by a digital ID, what happens if someone's access is restricted or revoked?
Who decides that? And based on what?
Exactly. Could access be denied based on political views, social credit scores, or failure to comply with certain mandates? Could transactions be censored or blocked? It raises fundamental questions about financial privacy, autonomy, and what happens when the infrastructure of commerce itself becomes a potential tool for social or political control. The analogy forces us to think critically about the power inherent in controlling the ledger of all transactions. Even if systems are designed with good intentions, how could they evolve or be misused down the line?
And it seems people are already wrestling with these anxieties. Our source includes some witty comments from online communities that are quite revealing. They're funny, but there's a definite edge to them.
Yeah, these often capture public sentiment better than polls.
Listen to this one. Stablecoin revolution. My bank account still feels like a zero-sum game. What's that saying to you?
That hits on a deep vein of cynicism, doesn't it? It suggests that for all the talk of financial innovation and revolution, whether it's stocks, banking, or crypto, the average person often feels like they're not really benefiting, like the fundamental game hasn't changed, the odds are still stacked against them, and these new tools don't actually translate into real improvement in their own financial lives. It's a feeling of being perpetually on the outside looking in.
Yeah, a weariness. Okay, here's another that really nails the core tension we've been discussing. Mark of the beast, or mark of convenience. Hard to predict, easier to panic.
That one perfectly encapsulates the dilemma. People see the potential convenience, the speed, the ease of digital payments, but they also sense the potential downsides, the surveillance, the control, the loss of privacy. And because the future path is so uncertain, because it's genuinely hard to predict whether this ends up being liberating or controlling, the default reaction for some is anxiety, maybe even panic. It's that uncomfortable feeling of stepping onto a path without knowing the destination. Is it progress or a trap?
And this last one is my favorite, darkly humorous. Waiting for the swap your soul for a coin clause in the next update.
Huh. Oh, while funny, that comment taps into the deepest fear that participating in the future digital economy might require trading away something fundamentally human. Our privacy, our autonomy, our freedom from constant monitoring in exchange for basic access. It suggests a future where our digital identity and our economic life are so intertwined that we lose control over essential aspects of ourselves. These comments, they're not just jokes. They are expressions of real, widespread apprehension about where this is all heading, about losing control in an increasingly digital world.
So putting all these pieces together, the tech, the regulation like the Genius Act, the history lessons, these public fears, our source offers a final comprehensive evidence summary that feels like a good place to try and land this. It says, the Genius Act's regulatory framework, technical benefits, and historical parallels show stablecoins on the cusp of true innovation or a gateway to pervasive economic control. It really feels like we're at a pivotal moment, a genuine crossroads.
We absolutely are. That summary ties it all together perfectly. On one hand, you have the clear potential for innovation, faster, cheaper, more inclusive payments enabled by the technology. And you have regulatory efforts like the Genius Act, trying to create a framework to manage the risks and build trust, trying to harness that innovation responsibly. But on the other hand, the historical parallels, Rome, China, and the very nature of digital traceable transactions serve as constant warnings about the potential for these systems to enable unprecedented levels of control and surveillance. The future isn't set in stone. Which path we go down depends crucially on the choices we make now.
Choices by who? Regulators, tech companies.
All of the above. How will regulations evolve? Will they prioritize stability and control over privacy and innovation, or vice versa? How will technology address the security and counterparty risks? And importantly, how will societies, that means us, individuals, choose to adopt or resist these technologies? What trade-offs are we willing to accept between convenience and control? This really is the so what moment. We're in a critical phase where the architecture of our future financial system is being designed, and the decisions made today will determine whether stablecoins and digital currencies more broadly become tools for empowerment and efficiency, or instruments that facilitate greater oversight and potentially limit freedom. It's a fundamental question about power in the digital age.
And that really crystallizes the dilemma we've circled throughout this whole deep dive, doesn't it? This undeniable potential for good innovation, speed, access, efficiency, pitted against these equally potent concerns about control, vulnerability, privacy, the potential for exclusion or surveillance.
It's a tension that demands we pay close attention, because as our source material wisely cautions near the end, evil doesn't erupt from thin air. It grows in the cracks of our unchecked trust and desperation. This isn't about saying stablecoins are inherently evil. It's a reminder that powerful tools need careful handling, robust safeguards, and ongoing scrutiny. We need to be asking ourselves constantly, where are we placing our trust in this new landscape? Who benefits? What are the potential unintended consequences? What values, convenience, privacy, autonomy, security do we prioritize?
So we'll leave you with that ultimate question, the one posed by our source material, for you to think about long after we finish talking. Is stablecoin the dawn of a freer financial era? Or is it the first step toward a kind of digital bondage? The answer, it seems, is still being written, and ultimately, it lies with all of us.